This is the heat map for the current time frame today, July 11th. Here is the basic information you need. The base URL is right here. You add the word background to get to a background video. The handout for today is posted as of about 3 minutes ago. And next week's meeting, you put in next week's date on there. So executive summary, real hot real estate market in Silicon Valley. The coolest area is right along the San Mateo, Santa Clara County border. What we're going to do is real quickly, we're going to do the weekly data, then we're going to get into the monthly data because I have June's data finalized. These first few slides are just to give you an overview. So it's looking at Santa Clara County single family home for the last 5 weeks, which is my benchmark. The blue line is inventory. The red line is number of offers accepted. Basically supply demand concept. Anytime the demand, the number of offers is above the supply, the blue line, the market's red hot. You can see we were in a red hot marketplace. Here's where COVID-19 was announced, the shelter in place. You can see we went into a buyer's marketplace, and now you can see the recovery out and that we're back into a seller's marketplace. Here is days unsold inventory, which is that ratio in a numerical term. You can see it went down, which is an improving marketplace. Then it went up, which is a decreasing marketplace. It takes longer. This is how long it takes to sell the existing inventory. And then you can see we came back into the seller's marketplace. Median days on market, you can see went down to 0, and that's because the MLS froze the number, weren't advancing it. So a new listing had 0, an old listing had 7, whatever the number was. You can see we rapidly climbed back up, and we're basically back at the same level we were before. Nothing unusual there, but again, the blue line up top is the important document to be looking at, in my opinion. This is the amount of overbidding. There's 2 different things on this graph. One down here is the frequency of overbidding. How often are sellers getting overbid? And as more sellers get overbid, you go into a seller's marketplace, this red rectangular. As you have fewer, you go back into a balanced marketplace and sometimes even into a buyer's marketplace. This is delayed because you need to have the escrows closed to get sale price. You can see that it's a more gentle curve because some escrows are quick, some are long, and it spreads out the impact. But you can see we're basically trading right along 50% more or less. The magnitude of overbidding is how much a buyer is willing to overbid. And you can see we were up here somewhere around 107, 108%. We dropped back down. We're right around 101% right now, which is sort of my threshold. I think I used 101.5%, and above is what I define to be a seller's marketplace. Just an arbitrary number, but it gives you an indication we're just right about there. It's interesting that both lines are going into a seller's marketplace at about the same time, which means that not necessarily the absolute numbers right, but the ratio between the two is about right. Now we're looking at sale price. Most people only follow the median, which is this middle line, the medium green line. The cheapest 10% is the lower green line, the lighter green line, and the top line is the 90th percentile. So this shows you what's happening in the most expensive areas. Prices have been basically flat. People have been saying we're going to crash. I don't see it happening, and I think it's the more demand than supply keeping the prices up. This data point here on the magnitude is missing, and I don't know why. I didn't have time to research. You can see that I have 27 data points on the frequency of overbidding, which looks like it's about 52%. And up here, the magnitude of overbidding is approaching 101.5%. The difference between this and the previous slide is this now is going to the macro data. This is where I look at just 1 week of data. So I throw in everything but the kitchen sinks. I put in single family homes, condos, townhouses, San Mateo and Santa Clara County, just what's happening in the Bay Area. So you can see both the frequency of overbidding is going up. The magnitude is basically flat. It's going up a little bit, but something that I've noticed in the past slowdowns in the real estate market, after we have a slowdown, buyers are more hesitant to overbid dramatically. So instead of spending 10% above the asking price, maybe they're only spending 5%. Well, that brings down that the cap, and that's why this number isn't going up as rapidly as the frequency of overbidding. So buyers are willing to overbid, but they're just a little bit more concerned. I think they get reminded that, you know, it's not funny money, it's real money that they're playing with. general concept here is this is what the sale price to list price distribution ratio looks like. In other words, you take the sale price to list price ratio of every transaction during a given period of time, plot that out on a curve, and this is what it gets. This one here is the hottest month we ever had. If you look at the dotted line up here, it turns out to be the best month ever was April of 2018. The second one down here is the best July that we ever had, because we're now in July, so I'm comparing it to July. You might argue I should compare it to June, but I'm trying to compare current data with current past data. So this is the best July we've ever had. So you can see April 2018 was better than the best July. The best July we ever had looks like it was July of 2019. Similarly, these are the worst 2 months. So the very worst month we ever had was December of 2000. The worst July we had was 2001. So obviously, you know that the worst July is going to be better than the worst December. And then in between, the more solid the line is, the more recent it is. So the red line is the current line, and you can see the solid lines are below it, which is indicating we're improving. Then the dashed lines are better, which are the next back, and then the dotted lines. So the way I read this is the dotted lines, except for the red and the blue ones, are the oldest data. So you go from here, you're slowing down, you go dashed lines, you're slowing down, you hit the solid lines, you turn around and you reverse and you're improving again. So that's the concept here. Now we've cleaned it up a little bit, and now we only go back to April 18th. Same concept. Here's April 18th, here's April 25th. Then you came down here to like May 2nd, May 9th. And basically May 9th would have been the bottom of the marketplace. And then you start seeing May 16th, the dotted line is sort of right at the bottom. The 23rd is right at the bottom. And then after May 23rd, we started to improve and going up. So the market's improving. It's lower than it was, but it's improving. Now we're looking at the individual components for just the last week. And this one, we're starting off with what I think is the most important, which is days on unsold inventory. And the golden line is the past 5-year median. And I'm not looking at the current year. So I'm looking at 19, 18, 17, 16, and 15, which were all very good real estate years. And then I'm looking at the median. And then you compare it to the raw data, which is the blue line. So you can see, and then the red line is the ratio. So remember, days unsold inventory being low is a good thing. It means the market's faster. It's turning over more rapidly. So now you're basically approaching 90%, 80, 95% of the normal DUI for this time of the year, which means the market is actually hotter than it has been in the past 5 years, which is pretty incredible when you think about it. Now we flip over and we just look at the active inventory that doesn't have an accepted offer. So this is available inventory for buyers to buy. Again, the golden line is the median. The blue line is the data point. And again, you're right on the median. So your red line is right at 100%. So as far as the number of active listings that are on the market are exactly what you'd expect it to be at this time of the year. Now we look at the number of new listings. So this is just what came on the market in the last week. The other was everything cumulatively that was currently on the market. You can see the blue line and the red line, or the blue line and the gold line are right on top of each other. So that puts the red line responding right at 100%. You can see last week there was a bit of a difference, and with there being more new listings last week than you would have expected. And that's because of the holiday. And that makes perfect sense to me. Normally people are going off and looking at vacations and those kinds of things. With shelter in place, less of that was going on. Real estate was an optional event. So not as many sellers hesitated about putting their house on the market. So last week we had more inventory come on the market than we typically did. This week we're back to right on normal. Now we look at the number of offers accepted. This is looking at the demand side after having just finished looking at the supply side. And you can see basically shelter in place was announced. The demand dried up. Then we could show vacant houses. Then all of a sudden we could show occupied houses, and the demand just kept roaring right back. So this is on a percentage basis. So the raw number is the blue line versus the gold line. And you can see the blue line is above the gold line, which is why the plotted red line is above the red line of 100%. So we're selling more homes now than we typically do for this time of the year. Now we look at closings. Again, this lags behind. You also have different durations of escrow, so this is more of a spread out V, where the previous slide was a sharper V. So right here, you can see that we're still closing less transactions than we typically do. The gold line is the typical, and that's why the red line is below the red horizontal line. Moving on to expired listings. The number here doesn't really concern me. First off, you're only talking somewhere around 50 listings. Then the real thing is what's going on here. I believe the reason we have more expired listings in the blue line, and you can see it in the percentage line, is earlier this year when shelter in place was announced, a lot of listings got drawn. As those withdrawn listings, it reached their expiration date, they show up as new expired listings. So we counted them once as coming off the market when they were withdrawn. We're essentially counting them a second time here as they expire. And that's just stupid, but it's the only way to do this because of the underlying rules of the MLS. I believe if a listing is withdrawn, it should come off the market at that point. If it comes back on, it should count as a new listing because it's rare that a withdrawn listing comes back on the marketplace. Then we look at the number of canceled. The number of canceled is a little bit below the normal 5-year median, not significantly. I'd call it right at. And the last several weeks, it's been actually now several months, 3 months, it's been performing right at the level. You might say it's been a little bit below, maybe 85% of normal. And again, that almost is expected because if the market is hotter than normal, sellers aren't getting concerned, their houses are selling, and they're moving forward. And finally, the number of withdrawn listings. There is no 5-year history here because once the expiration date has arrived, it expires and the withdrawn history disappears. This is just each component based on 100%. You can look up here, the new expired listings is the thing that's most out of whack. I already explained that. One, it's low number of properties. Number two, I think it's the withdrawn listings that are coming back and expiring. So ignore this, and we're basically having a normal year compared to the last 5 years, which are 5 real good years, which in a nutshell says we're having a real good year this year. Now we're going back and looking at historical stuff. This is based on overbid. This is going back 5 weeks, a month. So we're now at June 13th. You had most of Santa Clara County was in a hot marketplace. Your Southern County and Saratoga, Las Gatos, and your border areas were sort of in a neutral marketplace. San Mateo County was mostly neutral, with actually a little bit of cold here in the expensive areas. There was no change between the 13th and the 20th. Between the 20th and the 27th, the only thing that happened is Foster City, a very small market, disappeared and went from red hot to a balanced marketplace. From the 27th to the 4th, there was no change. And now to the 11th, there's no change. So this doesn't surprise me. One, there's the time lag. Number two, with buyers not overbidding as much, and I'm waiting both the amount of overbidding and the frequency, this is going to take longer to come back, and it will come back. People just need to forget what just happened, and that will take some time, just like 9/11, just like the 2007 mortgage meltdown. Now we're changing to current data, no lag time, because you're looking at, well, there is a little bit of lag time because you are looking at the 5 weeks of sales volume, but you're not having another 30 days for the escrow to close on top of that. So now we again go back to June 13th. You can see most of Santa Clara County, including South County and Saratoga, Las Gatos, were in a red hot marketplace, but the affordable areas were in a balanced marketplace. More of San Mateo County was in a red hot marketplace. The expensive areas and even Redwood City area was in a balanced marketplace. No change going to the 20th, the 27th. Now you can see a lot of the gray, a lot of the balanced marketplace disappeared, and we went more into a seller's marketplace. From the 27th to the 4th, there was no change. And now there was actually a little bit of change right here in Redwood City. I actually looked at the numbers. They were pretty minor. I think here you were something like 38 days of unsold inventory, so you were below the threshold of 40, and here you were something like 38 and a half. So it's, it is a change. It's not that significant. I haven't been able to do, and I may not do it. I've been talking about doing integrated, so this doesn't just go from red to gray, but goes from different shades of red to different shades of gray. Now, this data, just to warn you, is 1 day old. I don't think it changes much, but sometimes I've gotten surprised. So it was yesterday's data, Thursday's data back to 5 weeks Friday instead of Friday to Saturday, just so I have time to prepare it. So now you're looking at days of unsold inventory. The first column is whether you were a red hot marketplace, an ice cold buyer's marketplace, or a balanced marketplace before shelter in place. Then this is the current marketplace. And then this is whether the trend is more in favor of the seller or more in favor of the buyer. So basically you can see the single family homes, which are the two top lines, Santa Clara County, San Mateo County, then condo townhouse at the bottom. So the single family were in a red hot marketplace. They're still in a red hot marketplace. And for the most part, the trend has favored the seller. You can see that Redwood City right now on this data point here, and now again, this was a day old, was at 36.7. It clearly went up from 36.7 to something higher than 40, or I made a mistake, and I don't think that happened, but it's something I'll go back and look at. But, you know, again, 36.7 is still a seller's marketplace, but it's not 31.7. Then you look at overbidding, and I have the frequency of overbidding in this column, and same concept. The red is a red hot seller's marketplace. A lot of it was in a balanced marketplace. And then this is mostly favoring the buyer. And this again is the frequency. Now we look at magnitude overbidding. It was in a red hot marketplace. Some of it's in a red hot marketplace. Most of it's in a balance. Most of it's the same or favoring the buyer slightly. And again, this is because of the lag time, the 30-day escrow. Now you jump over to pricing. And pricing does not have any, you know, each area has its own price. So there is no definition of what a hot seller's marketplace is, which is why everything is neutral. It's just not rated. But now this tells you whether the prices are up. So a red line is the prices are up since shelter in place. Blue is prices are down, and white is prices are about the same. So overall, you can see for the most areas, prices went up. The condo townhouse market tends to be more neutral, and they tend to be more stable than the single family. The single family tends to have a more significant fluctuation during the year. Now we're going to go into a group of 55 slides. These are my 11 metrics, and then each metric has 5 graphs. I'm only going to be explaining one of the 5 graphs as I go. So I'm not going to explain this one. This one I will, because it's the highlighted one. And basically this is countywide data. And when I say countywide data, for the condo townhouse, it's condo townhouses only in Santa Clara County. The gray line is San Mateo County, and the red line is Santa Clara County. The biggest difference that I'm noticing on here is the condo townhouse market that I said tends to be more stable went from the fastest moving marketplace before shelter in place to the slowest market after shelter in place. So it moved the most. And my explanation, and I try not to do in too many explanations, is basically people that live in townhouses and condos tend not to have as many family needs and social needs to move. And so they're just not, the buyers aren't coming back in the marketplace. They're going to wait, where the single family have more social pressures, so they're right back in. Now, I've talked about these level being the 3-week and the 5-week, the 3-week and the 1-week plateau. Going up is a bad thing, but what I have to caution you about is the 1 week back includes July the 4th, which tended to have fewer sales even with shelter in place. So with less demand, your days of unsold inventory increases. So I would ignore this trend and basically expect the numbers to be flat for next week going forward. And I'm stepping through those quickly. I'm not expecting you to catch them, but if you wanted to look at them, you could freeze frame them, or they look at them on the handout. Now we can look at the currently available inventory across all 22 micro market areas, because Santa Clara County comes to the top. San Mateo and condo townhouses for Santa Clara County come up to the top because they're the largest areas. But the trend is basically the same for all. You were going up in volume like we normally do. Shelter in place, you had definitely a pause. You had the rapid recovery. Now we're sort of at the period of time where we're sort of at the maximum number of inventory. maximum number of inventory tends to be right around July 19th, but basically from Memorial Day to July 19th, the market is pretty flat as far as inventory and sales, and that's exactly what you're seeing. In fact, the maximum number of sales typically happens a little bit earlier in the year, the Friday before Memorial Day, where the peak listings typically happen after, which around July 19th, which is why the market slows down. Stepping through each one of these, moving on to offers accepted. The same trend, shelter in place, major slowdown, recovery. Now you can sit here and go, wow, this is concerning because you're looking at the 3-week and the 1-week data. But notice the 1-week data is actually up and the 1-week data is down. The 1-week data includes July the 4th. And I think that's causing that data to come down, which is one of the reasons I typically look at 5 weeks. So I would discount all these drop downs, and you can see it's consistent for all the different micro markets. Stepping through. Now we look at the number of closed transactions, the same exact pattern. We came up, shelter in place. Now, well, it's not exactly the same because of the delay. So you can see the number of closings peaked somewhere afterwards. It's a more spread out recovery, and we're still on the uptrend. We probably are another 2 weeks away from number of closings to level off and go flat. And again, same thing with July 4th being a holiday. Escrow companies were closed on the 3rd, one less recording date. That pulls down the 1-week average, so I would discount all the 1-week numbers. Stepping through. Now we look at frequency of overbidding. Again, I'm not going to discuss it here because it's hard. You can see the red line, but it's hard, so we're going to look at it here with the county data. Same pattern. Basically, it went up afterwards, and that's again because of the lag time. You can see it's more spread out. It came down, not as much. Still flat, and it hasn't started to recover. I would expect this number to start going up in the very near future, probably within about 2 weeks. Stepping through. Now we look at the magnitude of overbidding. This is very similar to the frequency of overbidding. Magnitude, I might say, is coming up a little bit more now than the frequency. And if you look at it, this is interesting. The frequency is up now on the 1 week, and that I think is a legitimate data point. And you can see a little clearer on the lines. We're somewhere above, north of 101%. Not very much. 3-week data is probably 101. It might be 101.3. This is probably about 101.6 on the 1-week data. Stepping through. Now we look at 10 percentile pricing. And Santa Clara County, basically flat. It's clearly up from shelter in place. You were at 800,000. You're probably at 850, 860 now. San Mateo County is definitely up. And this is the lowest number. San Mateo County is up from about 900, got up to about 1,100, maybe even 1,175 here. Now you're back down to 1 million, but it's still higher. Condo townhouses started off here at about 500,000. And, really isn't much change. And that's one of the things. Single family homes tend to be more volatile in the pricing, really getting impacted in the springtime. Condo townhouses are more steady climb throughout the year. Stepping through. Moving on to the 50 percentile price. This is what most people follow. Santa Clara County is basically flat, right around $1.4 million. A little dip down here. I think we got down to about $1,350. The thing that's noteworthy to me that I can't explain is this fairly significant drop in the median price countywide in San Mateo County. It's only 1 week of data, and that's why I'm not too alarmed by it, but this bears watching. I would not have expected this. Volume impacted, sales, the median sale price to be impacted. I wouldn't expect it. I would expect it in the downward direction if it was to happen, because the more expensive homes tend to be more family. They tend to be more vacation oriented, but this is single family. So, again, it's just 1 week data point with Friday being the observed holiday. It's only 4 days of data, essentially. I'm not going to put a lot of weight into it. Stepping through. Now we move on to the 90 percentile. Here, Santa Clara County shows a fairly significantly upturn. So it's basically saying people with money have money and they're going to buy real estate. They might be seeing it as an opportunity. San Mateo County, I would tend to say, is up. And even the condo townhouses, you know, are a little bit more up, but I would still tend to call them flat and stepping through. Now we're looking at duration of escrows. You can see they have slowed down. They're starting to speed up. Clearly a bad data point here, which surprises me, but you know, anything can happen. San Mateo County is back down to 29 days. You know, at this point, I would do a 30-day escrow. Median days on market, you can see we've come up. We're starting to level off. I'd expect all these to level off in the near future and stepping through. Now we have the actual data. If you want to look at it, this is as of this morning. You can see Santa Clara County single family wide DUI is at 30. You can see South County is at 27. You can also see Campbell, Santa Clara is at 27. You can see Cupertino, Sunnyvale is at 26. The Palo Alto, Los Altos areas, which is normally the fastest, looks like 48 or 46. So you can see the different areas. Each one of the data points is here. This is San Mateo County data. This is condo townhouse data. Now we're moving on to monthly data, and that's coming up next. This is just a recap, and that finishes up the weekly data. I'm going to go, and this is just the slides. The handouts are posted if you want to get a copy of these, a PDF. I think it's 107 slides. Next week's URL is here. Just telling you what monthly data is. I start on the first of the month and I go for 35 days. This is semi-log paper, so it's the slope of the line that shows you the appreciation. This is June data point here at the end, which is the most recent. July would be right on the second vertical faint line. I'm going to do it on the 10 years data going back to January of 2010. This is a normal analog pattern that most people are used to. The light green is the 10 percentile, the medium green is the median, and the dark green is the top 90 percentile. The horizontal line is left over from the 2007, 2008 recession, and you can see all areas are above their previous lows. The high end came back fastest, then the median, and then finally the low end. You can see the low end basically took to January of 2017 to cross over. The median crossed over in January 2015, and the high end probably crossed over in January 2014. Moving on to sale price to list price ratio. Here's the frequency of overbidding. You can see right now we're basically right at 50%. Before shelter-in-place impact, we were up here around 70%. I do expect this to come up. You can see the frequency, the magnitude of overbiddings up here. We were up somewhere right around 105. I thought it was actually higher than that, but it looks like it said 105 on the scale you can read, and we're right about 101% currently. And this is going to be single-family home in Santa Clara County for the month of June, which starts on June 1st and goes through July 5th, which is why I didn't have the data last month. I typically report on the second Saturday. Now, this is my overbid to underbid ratio. This is a nod to the stock market. They actually look at number of shares. I'm just looking at the ratio. I don't think it adds much. I was asked to do this slide, so here it is for those that requested it. Here is what I consider to be the most important data slide. This the blue line, days of unsold inventory. You can see the spike up with after shelter in place, and then the improvement afterwards. We're below the red line, so we're in a seller's marketplace. Here is the median. The pink is or fuchsia is the median days on market, and the golden line is the average days on marketplace. They got down here to 0 because of the freezing of the MLS. Here's the 10-year. Now I'm looking at a 12-year moving average. This gets a little convoluted and hard to figure out at this point, but inventory is now dropping compared to what it was a year ago. Basically, what this does is it looks at the data for June data, which for sales and closings is June 1st through including July the 5th. For inventory, it's just what the inventory was on July the 5th. So that whatever the metrics you're following, that's June data. I then go back to May data, April data, and go all the way back to July data of last year, and I plot out that average, and this is the average moving. So it shouldn't move up and down, but you can look at, sale price is typically on an up curve. You can see it actually went down a little bit. We're back on an up curve. Days unsold inventory is real time, so you can see it slowed down last year, which is a speeding up of the marketplace, came up here, and now it's been basically flat. And this you can't relate directly to shelter in place because it's comparing it to the 12 years. So shelter in place impact is still in this because of the increase that we had as a result of it. And that's why it gets a little convoluted. This is looking at the 10 percentile home compared to the median compared to itself, which is always at 100%, and the 90 percentile compared to the median. And what that does is it allows you to see this long-term separation back here in January of 2000. We had a little bit of a price compression right here through January of 2006. And then we had a price separation where the low end was going down and the upper end was going up a little bit or flat. And so you had price expansion going on. And now we're getting back into a little bit of price compression. Just a little observation more than anything. And I think that gets us to the distribution. So since we have a little bit of time, I think, left, let me try to explain this a little bit again. This now is data for June. It's going back 24 years. They're in groups of 8 years. The most recent 8 years are the solid lines. So you can see the current line is right here. And basically you can see, you know, and it bounced around a little bit. Here's 2018. Here looks like 2015. The golden's 2017. So there was bouncing, but all the recent years were better than the current year. The dashed years are the second best back 8 years, so 2012 through 2005. They're on both sides of the solid line, and the oldest data is the dotted lines. They're on both sides. So, you know, you're sort of in the middle of the pack, but this is more historical data where we're at, so people don't remember it. They remember it here, so people are going to say the amount of overbidding is less than they're used to, and it probably is. Now we look at just the most recent 12 years, so you can see, and you can see that this is, I think it's the second worst for the most part, you know, at least on the overbidding. On the underbidding, it's more in the middle of the pack. So again, this just says that buyers are now hesitant to overbid. And then this is looking at the last 13 months for where we've really been. And, you know, you can walk through this. It's a little bit hard to pick up, but basically you bounced around and then you improve, you know, working backwards if you start with January of 2010. So I think this green line is January of 2020. I misspoke again. And then we went to the blue line, which is February. Then we went to March. Then we went to April. And then we went to May, which is basically buried, you know, here you can see it a little bit buried right on top of June. And now we have the red line in June. So you can see we bounced around a little bit, and I'm noticing my axis got cut off there. Sorry, I didn't catch it in time. And now we're back to the end. And I have 3.5 minutes left to have questions from anybody. So if anybody's got a question and wants to unmic themselves, go ahead.
Okay.
Bye, Lily.
Thank you.
You're welcome. Bye, Jesse.